Welcome to Course 13 of the MaxLife Commercial Academy, NNN and Net Lease Investing. I'm Ryan Solberg, real estate broker at MaxLife Commercial, and this is honestly my favorite topic in commercial real estate. NNN investing is at the core of what we do every day at MaxLife. It's the strategy that lets investors collect rent from household name tenants. Think Dollar General, Starbucks, AutoZone, while the tenant handles taxes, insurance, and maintenance. Passive income backed by credit. Over the next 7 lessons, we're going to break down how these leases actually work, how to analyze a tenant, how to price a deal, and how to use NNN as a 1031 exchange destination. Let's get into it. Before you can analyze a net lease deal, you have to understand the spectrum it lives on, because the words gross and net describe a sliding scale of who pays for what. On one end, you have the gross lease. The landlord pays all operating expenses, taxes, insurance, maintenance, and charges a higher gross rent to offset those costs. That's common in office and multifamily, and it's the most management intensive, least passive structure there is. On the other end sits the absolute NNN lease, and this is the holy grail for passive investors. The tenant pays absolutely everything: taxes, insurance, the roof, the structure, the parking lot, and you collect net rent with zero obligations. That's what people mean by mailbox money. In between, there are gradations you need to know cold. A single net lease means the tenant pays taxes only. A double net, or NN, means taxes and insurance, but the landlord often keeps responsibility for the roof and structure. A true triple net adds maintenance on top of that. An absolute NNN means everything, with no carve-outs whatsoever. Here's why this matters. A property marketed as triple net might actually be a double net once you read the fine print, and that roof and structure obligation can cost you tens of thousands of dollars. Always know exactly where your deal lands on this spectrum before you ever talk price. Once you have a deal under contract, the lease document is your Bible. Here are the clauses that matter most. First, the primary term. A 15-year primary term on a Dollar General is worth significantly more than a 5-year remaining term on the same property, even at the same cap rate, because income certainty commands a premium. Second, rent escalations. Most NNN leases have scheduled rent bumps, either a fixed percentage every 5 years or a CPI adjustment. That escalation is the hedge against inflation embedded in your return. Third, understand who really pays the expenses. Some leases are labeled NNN, but contain a landlord carve-out for roof and structure. That's actually a NN lease. Read every expense reimbursement section carefully. And fourth, the guarantee. A franchise operator signing a lease is not the same as the corporate parent backing it. Know exactly who's on the hook if revenue drops. Tenant credit is the engine that drives NNN cap rate pricing. The stronger the credit, the lower the cap rate investors will accept, because they're paying for certainty. Let's walk through the 4 buckets. Investment grade tenants are publicly rated by Moody's or S&P at or above, Ba3 and BBB minus respectively. These include Walmart, Home Depot, Dollar General, McDonald's, and most major drug chains. Their financials are public, their debt is rated, and lenders love them. The second bucket is strong private tenants. Chick-fil-A is the gold standard. No rating, but average unit volume over $7 million and virtually no franchise locations. Raising Cane's and Wawa fall here too. For these, you dig into unit economics, system-wide sales, and press coverage. Third, franchisees. A Taco Bell operated by a 200-unit regional franchise group is very different from a single unit operator. And fourth, always underwrite the intersection of credit and lease term. A 20-year Walgreens absolute NNN is a bond proxy. A 3-year remaining term on the same Walgreens is a repositioning play. They're completely different investments. Cap rates are the universal language of NNN investing, and understanding them deeply gives you a competitive edge in every negotiation. The formula is simple: net operating income divided by purchase price. In a true NNN deal, the tenant pays all expenses, so NOI equals your annual base rent. That simplicity is a feature. It means you can compare a Starbucks in Tampa to a Dollar General in Ocala on a single metric. But here's the nuance most buyers miss. Cap rates aren't static. They compress with better credit, longer terms, and stronger locations. A Chick-fil-A in Orlando at a 4.75 cap is not overpriced if the lease is 20 years absolute NNN. You're pricing certainty. Meanwhile, a 7 cap non-rated franchisee on a 5-year remaining term is not necessarily cheap. You're paying for uncertainty. At MaxLife, we teach clients to run a full lease term return model, not just a going-in cap rate snapshot. Layer in the rent bumps, the option period rents, and what the asset might retrade at upon renewal. That's how you actually compare deals. Not all NNN tenants are created equal, and knowing the investor demand hierarchy is critical to pricing and sourcing deals. At the top of the food chain sit investment-grade tenants on absolute NNN leases: Dollar General, McDonald's, AutoZone, Home Depot. These trade at the tightest cap rates because institutional buyers compete hard for them. Just below that tier sit elite private tenants. Chick-fil-A and Wawa are the two that generate the most investor excitement. Chick-fil-A properties are among the most sought-after NNN assets in the country. Limited supply, exceptional unit economics, and no franchise model means every location is corporate operated. For income investors specifically, the sweet spot is often the middle tier. An investment-grade tenant with a 12-year remaining term in a secondary Florida market like Ocala or Lakeland. You get the credit quality without paying the Orlando or Tampa premium. At MaxLife, we actively work this category for clients looking to place 1031 exchange proceeds into passive income. The key question we always ask: would this tenant still be paying rent if we went into a recession tomorrow? Essential retail, auto services, and quick service food have all demonstrated they can. Deal flow is the lifeblood of NNN investing, and understanding where inventory originates helps you move faster and smarter than competing buyers. The largest pool of NNN listings sits on CoStar and LoopNet. These are the publicly marketed deals where every buyer has equal visibility. Cap rates on these listings are tight because competition is real. The more interesting deals often come from direct developer relationships. When a developer completes a build-to-suit Dollar General or Taco Bell, they frequently pre-sell the completed investment to a repeat buyer before listing it publicly. Getting into that pipeline requires relationships, and that's exactly what a specialized NNN broker provides. Off-market deals are the third source. Private investors, family offices, and estate situations often prefer discretion over maximum exposure. A trusted local broker in Central Florida is the most direct path to these opportunities. And finally, 1031 exchange networks. When a seller exchanges out of a property, they're under time pressure: 45 days to identify, 180 days to close. Qualified intermediaries and exchange accommodators actively refer their clients to NNN specialists because NNN closes fast and cleanly. At MaxLife, a meaningful share of our NNN transactions come directly from QI referrals, which is why we prioritize those relationships. The 1031 exchange is one of the most powerful wealth building tools in real estate, and NNN properties are consistently the most popular replacement property category, and for good reason. Think about the typical exchanger. They've owned an apartment complex or a strip center for 15 years. The asset has appreciated significantly. They're tired of managing tenants, fielding maintenance calls, and watching operating expenses climb. They don't want to pay capital gains tax, but they also don't want to keep working this hard in retirement. NNN is the answer. By exchanging into a Dollar General or Starbucks or AutoZone, they preserve the tax deferral, upgrade to a passive income structure, and lock in a credit tenant for 10, 15, or 20 years. The income is predictable, the management burden is essentially zero, and the asset value is transparent and liquid compared to many alternatives. The mechanics matter too. The 45-day identification window and 180-day close deadline create real urgency, which is why NNN deals are ideal. They are standardized, widely available, and lenders are comfortable financing them quickly. At MaxLife Commercial, we guide clients through the full exchange process, from identifying qualifying properties to coordinating with qualified intermediaries to closing on time. If you're considering a 1031 exchange, call us at 321-586-2121 and we'll walk you through your options. That wraps up Course 13, NNN and Net Lease Investing. You now understand the lease spectrum from gross to absolute net, how to read the clauses that protect your return, how to size up a tenant's credit, whether they're rated or not, how to underwrite a cap rate and price a deal accurately, which tenant brands consistently deliver for income investors, where the best deal flow actually comes from, and how to use NNN as a 1031 exchange destination. This is the asset class we specialize in at MaxLife Commercial, and it remains one of the most reliable paths to long-term passive income in commercial real estate. If you have a deal you'd like us to analyze, or if you're ready to start your NNN search, reach out directly. I'm Ryan Solberg, real estate broker at MaxLife Commercial, license number 3354351. You can call us at 321-586-2121 or visit maxlifedevelopment.com/academy for more free courses. Next up, multifamily investing. We'll see you there.